When you sell a highly appreciated property, the equity you unlock holds immense kinetic energy. If you want to keep that capital compounding, you have to divert it into a highly engineered, secure channel before it hits your personal accounts. In the 2026 real estate environment, preserving that wealth and avoiding massive capital gains taxes relies entirely on one specific mechanism, the 1031 exchange. The Internal Revenue Service governs these transactions through rigid technical protocols that leave no room for administrative discretion or retroactive adjustment. This schematic shows your first line of defense. When your asset sells, the equity flows directly into a secure lockbox controlled by an institutional steward known as a qualified intermediary, or QI. The IRS enforces a strict rule called constructive receipt. If you, the investor, touch, direct, or control that capital at any point between selling your old property and buying the new one, it triggers an immediate taxable event. Your QI's primary function is to shield you from constructive receipt. While they hold the capital securely, you must successfully pass through a three-part federal compliance system. Gate 1 is Treasury Regulation 1.1031K1C, which regulates exactly how and when you identify your replacement assets. Gate 2 is the 180-day rule, which carries a specific 2026 calendar collision for investors operating late in the year. Gate 3 is Internal Revenue Code Section 1031D, which mandates the precise mathematical engineering of your tax basis. These are pass-fail requirements. Missing a deadline by a single minute or miscalculating your debt load by a single dollar at any of these gates unravels the entire structure, instantly exposing your equity to capital gains taxation. This diagram tracks the first phase. From the day your relinquished property transfers, you have exactly 45 days to identify replacement assets in writing. The window closes permanently at midnight on the 45th day. Volatility or financing delays cannot pause this federal timer. To proceed, you must select one of three regulatory filters. Pathway 1 is the three-property rule. Identify up to 3 properties of any value. It caps quantity, not price. Providing a safety margin without complex math, this is the standard for 80% of investors. The second pathway is the 200% rule. Identify unlimited properties, but a strict valuation ceiling applies. The combined value of identified assets cannot exceed double the value of the property you sold. The final pathway is the 95% rule. Identify unlimited properties, provided you close on 95% of the total value. This is an institutional-grade strategy, utilized primarily by family offices and syndicators acquiring large, multi-unit portfolios where precision closing is guaranteed. Cautionary: these frameworks are mutually exclusive. You cannot legally switch from the 3-property rule to the 200% rule halfway through your 45-day window. The 45-day window acts as a strategic forced choice. The pathway you select dictates the scale, complexity, and risk profile of your entire acquisition phase. This Gantt chart shows the broader closing timeline. Theoretically, your total exchange period stretches out to a smooth 180 days to finalize your purchase. The caveat: the window is 180 days, or your tax due date, whichever is earlier. If you close late in the year, say November 1st, the 180-day line never finishes. A rigid barrier slams down on April 15th, tax day, physically cutting off your window. Any investor who initiated a 1031 exchange between October 17th and December 31st of 2025 will hit this premature wall. If you hit this wall without preparation, the IRS automatically categorizes the transaction as an incomplete exchange, triggering immediate tax liability on your gains. There is a specific operational bypass required to survive this trap. You must proactively file a federal tax extension. This document wedges under the April 15th wall, lifting it up and allowing your timeline to flow safely underneath to its full 180-day mark. This single administrative act legally overrides the tax day barrier, preserving the entire duration of your exchange. Failing to file this extension is one of the most common unforced errors that destroys fourth-quarter real estate equity. A professional investor must meticulously audit their 1031 closing calendar against federal tax deadlines. The standard rules only protect you if you understand how to navigate the filing dates that override them. Once you have secured your identification and your timeline, the capital itself must be mathematically engineered to fit the new asset. Internal Revenue Code Section 1031D establishes that tax-deferred basis is not an estimate. It is a strict, verifiable calculation. This balancing scale illustrates the exact formula required to calculate your replacement property's basis. Your new basis equals your relinquished basis, plus the difference between your new debt and old debt, plus any cash paid, minus any cash received. First, roll the exact tax basis of your sold property into the new asset. Next, adjust leverage. If old debt is heavier than new debt, the scale tips. Finally, liquidity. Any cash pulled out isolates as cash received, flashing red as boot. Conceptually, boot is any liability reduction or physical cash you pocket during the exchange. Boot fractures the tax-deferred container. This capital spills off the balance scale entirely, flowing straight into a taxable pipe, hit immediately by capital gains. Maintaining complete deferral requires exact alignment between your new asset's valuation, your lending structure, and your cash deployment. Basis engineering is the ultimate proof of a 1031 exchange. If the math doesn't balance, all the effort spent identifying properties and managing your timelines is wasted. This architectural blueprint reveals the complete operational model required to execute a successful exchange. First, you must explicitly lock in a mathematically sound 45-day identification strategy. Second, you must legally extend the 180-day window to bypass the 2026 tax deadline trap. Third, you must engineer your debt and cash precisely to eliminate taxable boot. Overseeing all of this is your bonded qualified intermediary, ensuring you maintain a pristine barrier against constructive receipt from the day you sell to the day you close. Mastering these three interdependent variables, identification, time, and math, is the definitive blueprint for compounding your real estate wealth tax-free in 2026.